Financial media often presents a very convenient, oversimplified promise. If the Federal Reserve just cuts interest rates, financial conditions will loosen across the board, and a single rate cut will fix the entire economy. This narrative leads the public to hyper-analyze Jerome Powell's press conferences, as if they were a new GTA 6 trailer, treating his every word as the definitive signal for where all market liquidity will move next. But this focus ignores the actual math behind the United States' trillion-dollar deficits, which requires the Treasury to issue massive amounts of new debt every year just to keep the economy functioning. By obsessing over the Federal Reserve, investors are overlooking a significant structural shift, one where infinite deficits are colliding with a world that is running out of cheap money. To understand our current position, you have to look at the difference between interest rates. The Federal Reserve really only controls the short end of the yield curve, specifically the overnight lending rate. But the long end of that curve, like the 10, 20, and 30-year treasuries, is what actually dictates the price of money for the things that matter, like 30-year mortgages and corporate expansion. These long-term yields are not dictated by central bank press conferences. They are determined by the raw supply and demand of the global bond market. If you want to know the future cost of borrowing, look past the Fed and identify who is actually buying and selling U.S. debt. Let's look at the supply side. The United States government is currently operating on trillion-dollar annual deficits. This chart shows the scale of the spending. To fund this deficit, the Treasury issues massive amounts of debt every year. This creates an ever-expanding supply of government bonds, requiring an equally massive pool of buyers. The entire system relies on the assumption that a price-insensitive buyer will always show up to purchase this debt, regardless of the volume. For several decades, that buyer was Japan. Because Japan kept their interest rates at zero for years, Japanese investors went on a global shopping spree. In the yen carry trade, they borrowed dirt-cheap yen to buy U.S. treasuries yielding 4%, pocketing the difference. This trade was so profitable that Japan became the largest foreign holder of U.S. debt, acting as a critical component of the global absorption machine. This constant foreign demand helped suppress U.S. long-term interest rates, providing the foundation for the era of cheap borrowing costs. But in 2024, that dynamic shifted when the Bank of Japan finally raised interest rates. Raising rates made borrowing yen more expensive, making the free money math of the carry trade no longer work. This sparked repatriation, a massive wave of Japanese capital returning home, pulling out of the U.S. bond market. Just as the U.S. Treasury is issuing record amounts of new debt, its most reliable customer is stepping back from the table. We are now seeing a structural collision. An infinite supply of new U.S. debt is crashing into a weakening pool of foreign demand. When demand weakens, the government must offer higher returns to attract new buyers, leading to a steepening yield curve. The Federal Reserve can cut short-term rates, but long-term yields stay elevated because the market demands more compensation for the risk. This shows how the mechanics of the global bond market can override domestic central bank policy. This has a direct impact on your wallet. If you are waiting for a rate cut to buy a home, remember that mortgage rates are anchored to long-term yields, not the Fed's short-term rate. If long-term yields remain high to attract buyers for our endless debt, mortgage rates won't return to levels seen in previous years. Housing affordability will remain strained. The same logic applies to stocks. Analysts value companies using long-term yields as a baseline. When those rates stay high, stock multiples compress and corporate credit tightens, even if earnings are healthy. Traditional media often overlooks these structural shifts because supply and demand in the bond market isn't as clickable as trending stories about AI or individual stock moves. Viewers should look past the promise of a magical Fed rescue and recognize that as global liquidity tightens, we are entering a period where money is simply more expensive to acquire.